Okay, welcome Jason and everybody here to this week's edition of Self Wealth Live Technical Analysis edition here. Jason, how are you going today? How's it going?
G'day, Roger. I am good. Good to be back for another show. Talk about some charts. Plenty of stuff going on the charts to talk about. So, yeah, hopefully some interesting things. And of course, for the viewers, got some questions. Let us know. Always good to go through them.
Yeah, of course. Well, those who haven't been here to one of our shows just yet, our format is pretty simple, right? It's kind of like we talk a little bit of stuff at the start, just one of my general questions, and then if you've got any questions you have around how to read charts, how to talk about price action, or anything to do with charting generally, chuck them in the chat down below. Or to the side or wherever you're looking at the chat, obviously. And then afterwards, we'll look at some tickers that you guys that hopefully will give us, and we can have a look and see what we think. When we get to that point there in our show. All right. So starting off this week, though, before I get to my general question of the week, Jason, do you want to just show us your disclaimers, please, or our disclaimers?
Yes. So, of course, everything today is general commentary only, no personal advice. And I'll put on a disclaimer which just goes through all that. And also an important point to note is that I'm not part of Self Wealth. I'm from Motion Trader. That's my business. And you can see my details in that top section. It's got all my licensing and things like that. And below that, there's a Self Wealth disclaimer with Self Wealth's licensing and such. And again, it all just outlines general commentary only.
Thanks, Jason. And yes, the boys are back in town for another week, Michael. Thanks for that. I like that. So I guess I know, Jason, that you are very sort of more about the technicals than the fundamentals of companies and whatnot. But I can't help but have to ask you your opinion on all the hype that's going on around this very, very famous Mexican chain of restaurants at the moment that was just listed. Guzman and Gomez, or Guzman, I think. Sorry if I don't remember. I like the food. I just can't believe the price that they came out. GYG. What's your thoughts on this whole situation, which is just it's gone nuts in the media, like over one small big franchise. I don't know. So
yeah. Look, I don't really follow the IPOs. What I'm doing, like I'm a trend follower. I look for trends in prices, and when a stock's listing, well, of course, there can be no prior trend because it's just listing for the first time. So I tend not to really focus too much on the IPOs, and of course, there can be some people focus exclusively on IPOs and do really well from it. So there's nothing wrong with doing that, but that's just not where my skills lie. And I think when we approach markets, we want to be approaching markets with an edge. Unless we have an edge, we're really just having a punt. So I don't feel I have an edge in assessing IPOs, so I don't go there. Some people do have an edge, so they will. My edge is with the price action, identifying the setups, the trends, managing the risk around them, and it might take a year before I get enough data to really populate the indicators like the moving averages and things that I look at. So Guzman and Gomez probably won't be on my radar for a few, probably at least 6 months before I'd say there's a trend for me to or at least price action for me to start to assess.
Yeah, right. Have you tried the food or?
My kids have, and they tell me it's a winner. So if they've captured the younger market, well, you never know. It could be a good business there in the and a good trends there for the future in the making. So yeah, we will see. But I'm quite like that sort of bit of that sort of food. So yeah, I must check it out myself.
It is pretty good, actually. So definitely have a try. It's probably one of the better of those type of franchise chains. So, but anyway, I'm sure we're not all here to talk about Mexican food. I just want to know if you really sort of or have in the past participated in any of these kind of maybe intraday movements or in that. Or have you known anyone at all that sort of participates in these kind of maybe when they first list, they get on the charts and they try to read it technically and try and make money out of it.
It used to be a case of like, and I've played the IPOs in the past, where you buy an IPO with the idea of making a profit on day one, but sometimes you don't. Sometimes it opens at a loss, and so there was an interesting study I saw a while ago that when a stock opens below its IPO price, there's the turnover tends to be lower, and the research around this, their conclusion was that the volume is lower because people don't want to take a loss on their IPO, so they hold it. Whereas if it opens at a premium, there's more volume because people are taking that quick profit. So it's an interesting look at the psychology of how we deal with profits and losses. People are quick to take a profit and they're slow to take a loss, which is this whole story in this on its own. People not wanting to being resistant to taking losses. This is how people get themselves in trouble in the first place. And it's interesting that this research just happened to be around IPOs. But look, I'm not really across the strategies for them. And as for trying to trade them intraday, it's like, I wouldn't even try that because there's no price action. It's too hard.
Yeah.
For me, it's too hard.
Yep, fair enough. All right. Well, if you do, just let us know in the comments and let me know how you do it. Would love to know myself, quite frankly. So, okay. Well, let's have a look at the markets at the moment. The Aussie market, Jason, what's that doing for us?
Okay. Well, let's jump over to the charts. And okay, so the ASX 200. Look at this, Rog. This is just such a distinctive trading range that we have forming up on the ASX 200. That really familiar triangle pattern with the converging lines, and you can really see how it's been coiling up. And that's one of the features of a triangle trading range. The price action coils. And the theory is, coils up like a spring, and then at some point it will release, and you get the new movement. It's had another rebound off the lower end of the range. You can got the 100-day moving average here. So we've got a bit of a rebound over the last couple of weeks. So it seems to be still a case of the dips being bought. So that's good. It's always encouraging to see the dips being bought along the lower boundary of this range, and also prior to that, the dips being bought all the way back to the beginning of the year. So that story hasn't changed. What we also have, though, we also have some distribution to talk about, and that's the distribution is at the top of the range. You can see each time we get up to the top of the range, the ASX 200 then comes and pulls back. And that's how these ranges work. So we've really got, I guess you could say, we've got a standoff between the buyers and the sellers. So the buyers are buying the dip, and the sellers are distributing into the rallies. So eventually one side is going to prevail, and that's typically where we start to see the new trend emerge. But we need to wait. We need to wait for a breakout. So it's pretty much a waiting game at the moment. I'm continuing to work on the basis that that this overall structure, when we look at this from late last year, November last year, the overall structure, I think, is positive. I think it's bullish. Nothing suggesting that there's a high forming at the moment. So we've got a strong, so that's pretty normal. So I think the benefit of the doubt goes to the bullish side at this point, unless of course we get a breakdown, unless prices break to the downside, to the downside of the range. Then we start to reassess, okay, what could be happening from there. But unless that happens, I think the probability favours the bullish case. That said, I sold a stock just last week. One of the stocks in the portfolio came back, hit my trailing stop. So it was an exit. And I think that's the way to approach this. I want to remain long stocks, and I'm using those wide trailing stops that we often talk about to try and see off this consolidation period that we're currently in. But it's also a case of protecting risk. So if a stock starts to lose its footing, starts to come back, it'll get the kick out of the portfolio. I'm also being a bit cautious when it comes to buying new stocks, just whilst we're in this holding pattern. I'd like to see this range resolve to the upside, get some momentum coming back into the market generally, then start to look at new opportunities. But look, overall, cautiously optimistic. We've got some clear levels to watch on the upside and the downside, and I think a good risk management strategy can really help us play the long side whilst keeping risk in hand.
Okay, you said you're holding off on buying a little bit at the moment. Is this just because of the range at the moment, or is this because there's no further capital, or you're fully invested? Is that?
No, I've got cash on the sidelines at the moment, and it's just me being conservative.
Yeah.
It's like I'm like, it's not just looking at this one chart of the ASX 200. It's also taking what's happening in the small ordinaries, the emerging companies, what's happening in the US, what's the internal structure of the US like. It's very much, and we can talk about this in a moment. It's been a very much big cap orientated market in the US. So there's always other factors to consider, and it just like, if I get a really good individual setup in a stock, I'm happy to go with it. But unless something's a standout, particularly whilst we're in a holding pattern, it's a case of like I'm very much staying long the market, but I'm just not keeping to pile in until we get some more confirmation that the next momentum period is in fact to the upside.
All right, fantastic. All right, Jason. Well, let's have a look at that US market then.
So we've got the S&P 500 here, and this is just such an interesting situation. Sometimes, Rog, sometimes markets are straightforward, and other times they aren't. And when I say straightforward, I don't mean that they're easy, but I mean the setups are clear. We can map out some of the possibilities with a reasonable degree of confidence. But at other times, pretty much like where things are now, they just get a bit more clouded. And I think that's the case here. I'd call this a more uncertain environment. I'll show you what I mean. So S&P 500, where we are at the moment. So the series of all-time highs has continued over the last week. On Thursday, by my count, we've got 33 all-time highs for this year. So all-time highs often lead to more all-time highs. So there's no problem with that. From that perspective, I think the trend is up, and we have a market that is just recently rallied off its 50-day moving average. So the 50 and the 100-day moving averages. We had a retest of the 100. That dip was bought. We've got another rally. Retest of the 50. That's been bought. We've got another rally. So that's all. I think that's all good. When you look at this chart on its own, I think it's a bullish structure. I think we've got a clear upward trend. So I think from that, we say the base case, like I said for the ASX 200, I think the base case, and this has been the situation since November, when prices got back. We went below the moving average, got back above the moving averages. Since then, that base case has been stay long, let profits run, see where the market goes, wide trailing stocks. It's been a pretty straightforward approach, same as applied to the NASDAQ. But I don't think we can ignore some of the things which are going on in other parts of the market. So, for instance, if we look at the Dow, the Dow's still not confirming the new highs in the S&P. Look at the S&P again, 33 all-time highs this year. The Dow still below its May high. And if we look at the S&P 500 on an equal weighted basis, it's below its March high. So we're not getting that broad momentum across the markets generally. And I don't think that's something we can just go, oh, well, it doesn't matter, because all these things are all part of a puzzle that we're always trying to put together. And I think this simply says the broader market's consolidating. I don't think this is bearish, so don't get me wrong on that. I don't think it's a negative structure. It's just saying that when you line up all the stocks on the market, most of them are not hitting all-time highs. Most of them are below their highs and tracking sideways. A bit like the ASX 200. We've got this coiling sort of structure in the S&P 500 equal weight. And there's another indicator I look at which shows around 50% of the S&P 500 stocks are below their 100-day moving average. So that's not what you usually expect during a bullish phase. So then you go, well, look, what's driving the S&P 500 if you've got all these stocks not really participating at the moment? And to a large extent, it comes down to one stock. It's got a few supporting actors with it, but to a large extent, it's NVIDIA. And it's just been on the charge for pretty much all of this year. Apple and Microsoft are also helping. So together they make up about, I think it's something like 30%. Maybe it's not 30%. Maybe it's about 20% of the S&P 500. It's a big number, whatever it is. It's an historically large number for three companies to be dominating the index. And so NVIDIA is an interesting one. I'm not into calling tops, let profits run, wide trailing stops, all of that. But having said that, I am into managing risk. So sure, I'm happy to let profits run in a stock which really goes gangbusters like this. But in terms of new money, it's not what I'd call an asymmetric entry point, just up at these current elevated levels. I think these are things we've got to bear in mind with the markets at the moment. Why I'm being a little bit more cautious. It's been stretched above these moving averages, really got stretched last week. We've had this snapback in the last couple of days, which is not surprising at all. And it's also interesting, what a key reversal day where the market opens at a new high, comes back, closes below the previous day's low. It's a key reversal day, and we've had some selling from that. And of course, then that flows through to the S&P 500. So we come back to the S&P 500, and you'll see, lo and behold, key reversal day as well, because NVIDIA is just such an influence on it at the moment. We had another key reversal day back here in May. It sounds ominous, a key reversal day, but it doesn't always lead to some major decline. Sometimes it can just be a pause. That was the case a few weeks back. It was just a pause, and it was off and away again. Sometimes the market runs over the top of it, but they're worth being aware of. That there can be some sort of a shift in the market flow. Look, I assess all this. I'm still long stocks, but look, as I was saying, a little bit cautious. My preference with the US market at this point, I'd rather buy the components. I'd rather have a look at something like the equal weight and buy the components within this. So look for a stock which may be rallying off its moving average or breaking to a new high, rather than putting new money in the S&P 500, which is really NVIDIA and Apple and Microsoft based. It's like, do I want to go out and buy those three stocks at their highs at the moment? Probably not. They might keep running. I'm not saying tops, but I'm saying from an asymmetric risk reward perspective, they're not my standouts at the moment. So happy to hold stocks that have run hard, not in a hurry to buy them, and look, as a risk manager, I don't think some of these S&P 500 stocks are asymmetric opportunities at the moment. Again, wide trailing stops, try and see off this pullback we're getting in the broader market.
Yeah, and do you have would you have a level in mind that you're saying, because obviously it's not a very, it's not a symmetrical setup right now. Would you have a level that you want the market to come back down to before you start getting a little bit more, into buying stocks? Or
well, it's as I say, I'm into buying the components. I'm open to buying the components. Like this is why I say, like, sometimes it's straight. The setups are straightforward. Other times they're not. It's like just this stark difference between the S&P 500 and the S&P equal weight. It's like that throws me a bit in terms of like how to manage this. Some people say just dismiss it and say, oh, the equal weight doesn't matter anymore, and the Dow doesn't matter anymore. It's an olden day index. It's like all about now the technology and stuff. And I don't know, maybe, but for me, like, this time isn't different. They're important indices, and the equal weight's an important ETF. It shows you what the broader market is doing. The stock market isn't about three stocks. It's about a whole market of stocks. So like to look at the components. I'd like to look at the individual setups. If I get a stock which looks good on its own basis, I'd rather buy that than just say, look, I'm just going to buy some S&P 500 here, because I know that's been largely fueled by those three stocks we just spoke about, and they may be great stocks, but they've had such extended runs. For new money, I just don't know that I want to be throwing new money into them at the moment. If I've got money in them, fine, let them run. But as I say, it's not about calling tops, it's about managing risk and finding out, just deciding for yourself, like, how do I want to manage risk? Is it by getting on what's hot, or looking for breakouts in other parts of the market where maybe there's not as much focus? And that's probably where I am.
Okay, very good. All right, let's have a look at the Hong Kong market then. Yeah.
So the Hang Seng, another week of consolidation. I think it's encouraging that it's holding. The prices seem to be finding some support around the moving averages. So again, the 50 and the 100-day moving averages. It's been hanging around down here for the last 2 or 3 weeks now, and I still want to play this from the long side at this point. I'm giving this emerging uptrend the benefit of the doubt. Like what I like about this, I like this strong rally we've had through April, May, and this pullback does look quite corrective in that it overlaps a lot. It's choppy, it's all a bit messy. Whereas the up move was strong, was powerful. There wasn't a whole lot of back and forth. The back and forth price action is more in tune with a counter trend move that corrects an earlier advance. So that's why I think the benefit of the doubt goes to the upside still. I think it's important that prices stabilise near current levels. Definitely want to see them holding above 1,700, and below 1,700 it starts to change the whole structure. But that's not where we are at the moment. At the moment, while we're holding the averages, it has that potential to now rally off there. Looking at the Chinese market, the rally hasn't been as dynamic as we've had in the Hang Seng. It's been a decent rally off the lows. Some moving averages have crossed, so that's one of the building blocks of an uptrend. So it's got that overall potential for an uptrend to develop, but I think we really need to see it start to hold the line near current levels, come back. It's below these moving averages. The moving average is starting to roll. It's not necessarily a problem at the moment, because it could very well stabilise somewhere near current levels. I wouldn't want to see this fall a whole lot further. Now it's below the averages, and the averages are starting to roll. I still favour looking for opportunities on the upside, but this goes for both of these markets. I'd like to see prices stabilise and then start to rally. So I don't really want to be buying into this weakness at the moment, because it's too much of an early. It's too early in a potential emerging trend in this. I'd rather see get a bit of a rebound, maybe a consolidation, and then buy into the strength. That's how I'd like to play this one. If I was in it, it's still a case of letting it run, wide trailing stop. But it's still an interesting one, which we could still see some upside in. But yeah, let's just see whether it can stabilise around current levels.
Yeah, fantastic. So we're waiting on the Hong Kong and Chinese markets at the moment. All right, so let's have a look at some questions here then, or some tickers to start off with. Let's have a look at WOW. WOW, please. WOW.
So Woolworths. And this has been an unexciting stock for a while. So let's just see, just compressing that, just getting. So I've got an old trend line on. We must have spoken about this, some time ago, and you can see the trend line was a useful indicator. It's just like, for me, the moving averages tell the story, but the moving averages are like a dynamic trend line. Whereas these trend lines that like link up previous lows, they give you a good visual as well. But I'm actually going to take that off. I don't want to be distracted by that. We don't need that for this. And now let me just check something. Yeah, just making sure I've got the correct moving averages on this. So big trade, you can see this big trading range through here that has been in that's spent quite a bit of time in. It's just sort of getting to the bottom side. I've just drawn roughly like the boundaries of the trading range. The momentum at the moment is to the downside, so it's not a stock I'm ready to buy just yet. If I was holding it, I'd keep holding it at the moment because maybe this is some sort of reversal underway. Like there's different ways to look at this. We could say it's tried to break from a trading range, it hasn't got follow through selling, and instead it's rebounded back up to above the moving averages, back up within that range. So that could be positive. We could also possibly say it's got that sort of zigzag correction. So we've had a big rally over many years, and we've had a multi-year zigzag correction. That's also a possibility. So you've got a couple of things there suggesting that look, there could be cause for some optimism in Woolies, but it's just a little bit too early for me. We've gone from below the averages to above. I'd like to see the averages cross. Maybe we get a period where we do get some back and forth while the averages cross, and then if we start to see another break to the upside, this is when I'd get interested. And of course, I don't know that the price action is going to play out like this, but often we do see this sort of price action where we go from below to above the averages. We get some sort of a sideways move while the averages turn. Many ways things can work out, but this is one we see a bit of. So I'd be looking to buy the break up from the next consolidation. So for me, a little bit early to buy, but it's one which could turn around. It's been out of favour for a long time. A lot of people have probably given up on a stock like this, which doesn't do much for them for say 3 years. But that can also be when these things get interesting. So keep an eye on it, I think.
Okay, fantastic. What about HLI?
So this was a motion trader stock that hit its stop loss last week. So the initial signals probably somewhere background here where the moving averages are crossing, had a really nice run. But then look, not every trend turns into a mega trend. Most trends just they go a modest way and then they peak and they come back. It's this is what we need to let profits run because we don't know which trends are really going to extend out. This one hasn't. It's good start, didn't go on with it, came back. My wide trailing stop initially saw off the pullback, started getting the rally, but then it's come back down again, triggered the stop. Interesting in that it's come straight back up. I'd just leave it alone. Like if I had a position this, I would have if I had a position this, I probably wouldn't have been stopped out of the day because I'm not sitting live stops. I would have looked at my end of day data and seen it had triggered the stop, and I would have been looking at it the next day. So I could have sold it near the open, or if I was a bit late and looking and looked at it later in the day, got a bit more of a rebound, I'd probably still be closing it. I'd probably still close it out and just take the windfall bounce. But if there's always different ways you can play these things. I'd probably be out of this stock if I was in it. I certainly wouldn't be looking to buy it at this point. Now it's below the moving averages. It's all just become a bit of a mess after this big gap down. I'd be just steering clear of it now and leaving it to the side. Let it settle down and come back and reassess the price action later on.
Okay, fantastic. IRI. This has been on the list of late.
Yeah, so this was so this one here. It really happened quickly. We got a signal for this stock back in late April. So this is how it looked in late April. So we had the moving averages cross. broke to a new high, so that triggered an entry signal for this stock, and that's a nice looking structure. You look at that, you could potentially got a long period decline, long lengthy basing period, and then you start to get that upward momentum. Again, you don't know which upward momentum breaks are really going to lead into big momentum periods. Pull back towards the moving average, kind of like what I was talking about in Woolies, where you go from below the averages to above, you get the sideways move into it. We've got that sideways move back to the averages, and then it just took off in one day. And then it was away. We've now had another consolidation, another run to a new high. This is definitely one. If I was on this one, I'd certainly be letting this run with a nice wide trailing stop, and see where it goes. Like, you look at where it came from. There's certainly plenty of upside potential there. Whether it can deliver on that potential, we don't know. But you give these things some. I think we want to be optimistic with our profitable trades. We want to hold them, give them every chance to keep running. And actually got another motion trader signal for this yesterday as it broke to a new high. So it's the momentum's in place, the trend's in place. Like I was saying earlier, I'm just cautious around buying at the moment. But look, momentum's there. So it's a case of, like, I think if you get on now, you just got to think about how you manage your risk. You're probably back down here below the 50-day moving average. If you're comfortable with that, I think the upside potential is still there to support it.
Okay, fantastic. Now let's have a look at BOT, please. And guys, don't forget, if you have any other tickers, even in the US, right, we can have a look at those as well, US or Hong Kong markets. All right, so.
Yeah, so there's always going to be stocks at different, like, trends. We can look at trends at all different stages, like emerging trends, like we were talking about in the Hang Seng, trends which have been in place for some time. This one's been rallying. Really, it's met the criteria for a trending stock since back in March, when this is last year, back in March last year, below the moving averages, got above the moving averages, crossed. This has been a trend with which a wide trailing stop could have managed quite nicely and would still be managing. So if I was in this one, I think it's one to hold. It's buying it now, maybe a little bit. Well, look, the trend's up. There's no doubt about it. It just comes down to managing risk. So it's like, where do you put your stop loss if you were to buy it now? I probably wouldn't be so keen to be buying it now after such a big run, with it being a bit stretched above these moving averages. I'd probably rather wait for a consolidation, look how the price action shapes up then. But it's certainly a hold. If I had it, it'd certainly be a hold with that, again, that wide trailing stop.
Okay. All right. IPG.
So this has been a stock which has been consolidating for a bit. So nice upward trend in place through 22 and 23. We just had that sideways consolidation. It looks constructive. It's certainly a stock I'd be continuing to hold. Nothing here suggesting there's a top in place. It just looks like it's that at this point anyway, it looks like it's that standard sideways motion after a long trending period. In terms of buying, like, different ways you could play this. Like, if there was some reason someone really liked it, like, the moving averages have just swung to the downside at the moment, and that's not unusual during a lengthy range-bound period, because price will oscillate either side of the moving averages, and the moving averages kind of start to flatten out. That's kind of where we are now. So the moving averages are pointing down, but I wouldn't call that downward trending averages. I think it's just all part of the sideways motion. If someone really liked this and wanted to buy it, it's a good upward move today. It's just gets it back above the moving averages. Look, I wouldn't. I wouldn't buy it. I wouldn't buy it today. Risk could be easily managed just putting a stop just below this previous low at 10%. But yeah. Look, there's nothing to say this isn't going to just like we just saw in May. We get a short burst up, then it pulls back. Could be a short burst up, then it continues to pull back and meander within a range for a bit longer. I'd probably want a bit more upside before I look to putting new money into it. But I'd be happy to sit there and hold it if I owned it.
All right, fantastic. All right, let's have a look at PNC, please.
Yeah, so this one's fallen from great heights. This you can see, like, it's interesting when you see these drawings I put on from past times, and you can sometimes they show you how a setup has worked well. Sometimes they show you where it hasn't worked. So you see this downward. It's like it's a wedging type pattern. This compressed both two downward sloping ranges. So you'd call that it's a downward sloping wedge pattern, which they break to the top side, and they can be the start of a new upward trending period. So we've got a breakout in this one, but the breakout didn't stick. It started to fall back, and then these sort of trades, you manage the risk with them, you just close them out, take a relatively small loss, move on to something else. So not every setup is going to lead to a big trend, and that's completely okay. We don't need every setup to lead to a big trend, but we need to manage risk with every setup. So the ones that don't play out, fine. Be a little bit wrong early, take a relatively small loss, move on to the next idea. And so then this can just stalled and went sideways for a bit, then started to fall back. And so it was like once we saw that breakout wasn't running, it was just time to move on. And that would have been the right call. Continues into drift lower. Brings us to present day. So we've got the makings of an emerging trend. So we've gone from below those moving averages to above. The averages have crossed, starting to make its way higher. I like how when we have like a strong upward phase and then we have a sideways phase back into the moving average, and then we have a breakout again. So these are all things which can lead to more momentum. So I'd say the odds favour being on the long side of this, on the side of the momentum, and then managing the risk. So then the risk, you say, look, buying at current levels, stop loss just back below the 100-day moving average could do the job there. So you can have a relatively tight stop loss on a stock which does have, it's got considerable upside potential. It's one of those stocks which could double. And I do could with an underline, could double, because of course it may not, could also halve. But if it halves, that's okay, because we've got a risk management strategy. We cut it well before it halves. But if it doubles, we let our upside run. And so that you can see how we keep that positive skew in the portfolio by we're getting out of things before the really bad stuff can happen, unless of course something gaps lower, which you can't do much about that. But for the most part, we can keep ourselves out of trouble by getting out of stocks relatively early, but we keep that positive skew in our portfolio by letting stocks run when they start to go. So this is one of those ones which, I think you can get on board and see if it goes. And if it doesn't, jump out.
Okay, fantastic. We might have a bit of a breather with the stocks at the moment. There's a question: should wide exit stops be modified for volatile trading stocks when the stock is clearly trading down?
So read that again for me, Rog.
So should wide exit stops be modified? Should wide exit stops be modified for volatile trading stocks when the stock is clearly trading down?
Well, this is where an ATR stop helps. So an average true range or an average trading range based stop, as opposed to just using, let's say, a 20 or a 25% trailing stop. It's I don't know, and I think the answer is no. I don't think that if you're in an established upward trend and you've got your wide trailing stop, well, the only way to get to the wide trailing stop is to trend down. So, by nature, to trigger it, it's got to trend down. But there are going to be periods where it does start to trend towards it, then it stops, stabilizes, and rallies again. That's why we use a wide trailing stop, so you can see off those periods. And you backtest these things. You backtest them over hundreds of stocks or thousands of stocks over 20 or 30 years worth of data, and you build confidence around why a wide trailing stop works. I think the wide trailing stops, just a lot of people can't use them because they find it too uncomfortable to sit through the pullbacks. You've got to this is where backtesting is so useful, because you can, rather than just hear someone say, oh, look, wide trailing stops are good, they help you stay in the trend, you've got to actually put the effort into going through and testing it out for yourself and seeing, okay, well, let's put this to the test. Here's a stock which rallied 300% over 3 years. What would have happened if I had a 10% stop, a 20% stop, an ATR, a wide ATR-based stop? What about this period where it fell 35%, but the wide trailing stop held me in? And then you start to build that confidence around, well, look, okay, this is why we're actually using that wide trailing stop, so we can see off those volatile periods. And a stock which is prone to volatility may come back 35%, but an ATR-based trailing stop, which is calculated based on the stock's recent volatility, may well be able to see off a 35% pullback, whereas a 25% or a 20% trailing stop won't. So, yeah, I don't think we should be adjusting our stops upwards, our trailing stops. Maybe you're doing something different with your initial stops. If you're using a wide initial stop and a stock's struggling, it starts to roll over, it gets back below the moving averages cross to the downside. Maybe you say, look, this trade's not working, I'll take a relatively small loss now, I won't wait for the initial stop to hit. But in terms of a wide trailing stop, you don't want to fiddle with your rules too much. If your rule is to use a wide trailing stop, I think that's the play, you use it. You shouldn't be second guessing, oh, look, I think it's going to come back and hit my trailing stop, so I'll close it early. Might as well not have a trailing stop. Might as well just use discretion as to when to sell. It kind of defeats the purpose of having these processes in place in the first place. They're there to help us avoid second guessing what the market's going to do and help us unwind our emotions a little bit, so we don't get too knocked around when we do get those big pullbacks, which are inevitable in almost every big trend.
Yeah, good response. Try and keep consistent with your rules is the most important thing, right? So, but because the ATR is there to account for the previous, like the recent range, right? So if you're just going to modify and do it yourself, then there's no point of an ATR stop, right? So based on what your feelings are. All right, so let's quickly go back into the charts and we'll have a look at Dro, please. Dro's another one of great been in the news lately. What happening with it?
Yeah, Drone Shield, and this has had a terrific run. This is like I've got some Drone Shield in the portfolio, and I continue to hold it. I'll let it run. I'll let it come back and ultimately hit the trailing stop, which is still, I don't know where it is offhand, but it's a long way. It's probably back near the 100-day moving average. I find it very difficult. Well, I wouldn't buy Drone Shield here. It's so stretched above the averages. At some point, everything, unless something gets taken over or delisted for some reason, everything comes back to the moving averages. I just don't know where they'll meet again, whether it be at a higher level or Drone Shield actually pulling back towards where they currently are. So I'm not a buyer. I don't think it's an asymmetric entry, but I'm happy to let a winning position run, use that wide trailing stop, and just with wide trailing stops, like look at these pullbacks and Drone Shield. They look like non-events when you look at it. After they're passed, in hindsight, they look like, oh, what's the big deal with them? You could easily hold through that. But let's actually measure them out. Like that's a 37% drop. Like, and this is what's this one? This is a 33% drop. So many people, unless they've got that calculated procedural exit strategy, so many people can't see off a 30% plus pullback. I've seen off both of them. I've barely looked at the stock during that period. It's like the trailing stop's there. That's my exit point. And it's a volatile stock. It's going to move around. So that's why we have many relatively small positions as well. So you don't have all your money in that one stock, which is just gyrating around with these big percentages, because you just can't emotionally withstand that. It'll just drive you out of the market. So we've got to allow for these big pullbacks, and the ATR based trailing stop, wide stop. I think that's the way to do it. If you're jumping at every 10 or 20% pullback, it's going to be really hard to stay on many big 100, 200% plus trends.
Okay, fantastic. All right, let's have a look at this question here. I'm wanting to buy an ETF. Based on the current charts, which looks better, NDQ or IVV?
It's the NDQ, so it's a NASDAQ ETF.
NDQs looks like a...
So, well, this, okay. And what's the IVV was the other one, was it?
IVV was the other one, yeah.
IVV. So it's NASDAQ or S&P 500. It's NASDAQ has been the strongest performer, but that doesn't mean it will always be that. It's probably also the more volatile performer of the two. They've both been outstanding. If you're in either of them, it's done well, and they're both going to be. There's going to be a strong correlation between the two of them, because I think the three lead stocks are in both. Microsoft, Apple, Nvidia. They're in both. They're going to have a bigger weighting in the NASDAQ 100, I imagine, because it's 100 stocks in the NASDAQ 100, which is NDQ. NDQ is probably the NASDAQ 100. It looks like it's a NASDAQ 100. So it's, they make up 3% of the stocks, whereas in the S&P 500, they make up 3 out of 500 stocks. So look, there's no best. I certainly can't say which is the best to get into, because I don't know how the future's going to unfold. And they're both on uptrends, and they're both going to have a strong correlation to what the big three do. So it's sometimes it's a case of having both, having a portion in both ETFs. That's also something to consider. It doesn't always have to be either or. You can do a bit of both, particularly when you're paying $9.50 for brokerage through something like through Self Wealth. It's not like days gone past where you really had to consider, okay, look, I only want to pay brokerage once, because it's going to be such a big portion of the what I'm investing. Maybe that's a consideration, a bit of both, if that's something you're wanting to do.
Yeah, it's good tips, because at the end of the day, if they're both the same, he's kind of just splitting hairs between them, right? So, but if two can be better than one sometimes, right? Because one could go up a little bit and the other one could just sit there. But generally, they're both going to be tracking next to each other, right? If they've both got the same stocks in them. I like that response. All right, so let's have a look at the next stock, please. DXC.
DXC, is that it? Dex's Convenience?
Looks like it, yeah.
Yeah, I looked at this a while ago when it turned up in the motion trader signals. Must have been, I'm not sure when it was. Maybe I was talking about around March, where it just pulled back to the averages. Looked like maybe it was going to get going, but was had more sideways. I think it's a really interesting one. I think it's got a nice dividend attached to it. You've got to go and check all that fundamental stuff out for yourself. But I'm pretty sure there's a nice dividend attached. Looks like a trend reversal, in that we've gone from a downward trending phase to swinging back to the upside of the moving averages. The moving averages have crossed. We've had this sideways period back to the averages where it's stabilized. So it looks like maybe there's some accumulation and buying of the dip going on. I think it's one which could see further upside. Maybe if talk of interest rate cuts continues, and this got to that can be a good thing for yield based investments. I think it's an interesting one worth considering. It's probably not one of those ones which is going to double anytime soon, but that doesn't need to be the criteria for investing. Maybe you've got to check the yield. I don't know. I'm guessing at numbers. Maybe it's between 4% and 6% thereabouts. Maybe it's a good yield. Could be at the higher end of that. It could be a nice stable stock to have a look at. So look, I like the overall structure. I like the idea behind it.
Okay, fantastic. Let's have a look at LMT on the New York Stock Exchange.
It's
Is the weapons company?
Lockheed Martin. So been really got this sideways period over the last 18 months. The overall trend is to the upside. It's whether I'm probably not ready to go out and buy it just yet. It's this general sideways period. Has it ended? It's we don't really have a decisive breakout in this at this point. Although maybe it's not too far from it. Just looking could we say there's resistance? Could probably say there's resistance around this 470 sort of mark, which is just starting to try and claw above now. If someone really liked it, maybe just give it a little bit more room. Let's just see if it can just clear these recent highs, maybe around 480-ish thereabouts, and then a stop could be just back below these recent lows, back below the 100-day moving average. So maybe you're looking at a situation where you've got about 7% of risk, and then the upside is open. Who knows where it can go. So that'd be one strategy. Of course, you can have much wider initial stops. Depends what you're trying to do, how you want to play it. But I'd probably want to see it a little bit higher, because there's also the chance that then it does peak around here, it starts to pull back towards the lower end of this broad range it's been in. So I'd probably leave it for now. But it's worth keeping an eye on. If this range breaks to the top side, it could have a good run.
Okay. All right. We'll have a look at MIN first, MIN. There's a couple of final questions there we'll go through as well.
So this is so I think would this be a rare earths company, Mineral Resources, because it looks a bit like stocks like Linus and Pilbara and Iluka, and they look like they'll potentially had the signs of these. Potentially had the signs of an emerging trend, but it just didn't follow through. It's all just come apart. And something I've spoken about a bit in the last few weeks in my weekly strategy sessions as well. And it's not time. It's just not time. It looked like maybe it was going to be the setup for these stocks to run, but they haven't followed through and they've broken down. So I took a stake in Linus, which is LYC. I bought it on a breakout. The breakout didn't stick. Well, I'll show you Linus. Show you how I played this. I bought the breakout, and when the breakout failed, I sold it just as it got back to the 100-day moving average, and it's continued down since. So I took a relatively small loss. Wasn't working. Nothing to see here. Just move on, take the money out, do something else. And that's very much the case for me with MIN at the moment. The situation, what was an emerging setup, it just didn't play out. So I'd be I'd be out. I'd just watch from the sidelines for a while. I don't know where it goes here. It could base around here and just continue to chop around, and then maybe it has another go at going higher in several months, 6 months, 12 months, whatever it may be. Or there's also nothing to say it doesn't have a consolidation and then break lower again. We don't know. So it doesn't have upside momentum. So for me, there's no reason to be there now. And I certainly don't want to try and pick the low because it's we just don't know. It's trying to pick a low is just too risky in this situation. It's not like it's pulling back to moving averages and you're buying the pullback to the average. This one is now clearly broken below the averages. So it's, for me, it's just step back and leave it alone.
And try not to catch that falling knife. All right. So yeah, we'll get a couple of questions here, and it's around the stops, I guess, the ATRs. So first of all, I think this is a quick one, but do you ever take into account, like with the wide trailing stops, there's several stocks that are sort of out of favor now and probably about to be hit, but do you ever take into account the fact that they're a good business, Jason, and keep them based on that? Or
no, because things can change. You can have let's just let me just see whether I can just get an example of something first before we move on with an ATR stop. I'm just going to go and I'm going to modify the parameters around this. That's the wrong one. There's the one. I changed the multiplier to 10 because I use a 10 ATR stop with some other changes to it, but just roughly. No, I wanted to see whether an ATR stop could have seen off this pullback period, but that was too big even for an ATR stop, and that's going to happen. So back to the question. Like for instance, I remember A2 milk when it was selling off, and during this period here during 2020, 2021. And I kept hearing fundamental types like through the media talk about how it was a really well-run company, and that there was value there, but the trend was clearly down. So it would have been a case for me that like it would have taken out the trailing stop somewhere probably in late 2020 and then been below the moving average. I just would have stepped away and stayed away from it until potentially looking at it again in October 2022. So 2 years on the back shelf, not to be looked at. But for someone saying, look, it's come back to the trailing stop, but this is a really well-run company. I think we can just let this be a bit flexible with the stop on this one because it's such a strong company, they're going to come good. But you can see the risk with doing that. Sometimes they don't. It's like, yeah, sure, some of them will come good. And you go, see, I told you it was going to come good. What were you panicking about? But they're not the problem. They're not the ones that ruin your portfolio. The ones that ruin your portfolio are when you move your own goalpost for getting out and you give yourself an excuse to do nothing. And then you've got to sit through as it continues to deteriorate. They're the ones that become, the lead in the portfolio that drag it down. And so now what are you doing? You're down here and it's down, whatever it is, 80% or something, and you're still hoping it's going to come good. Maybe it will, maybe it won't. I think this is where a lot of people get into trouble. So I think the best we can do is we just got to be consistent. We've got to have our rules and follow them as closely as we can and not let us relatively minor hiccup get away from us to the downside, because these situations can just become unrecoverable for some people when they have too many disasters in their portfolio that they did nothing about when they should have, and it's so hard to come back mentally, financially, the whole thing. So I think everyone's got to do what's right for them, but just be very careful telling yourself, oh, I can give this one a bit longer because ... feeling whatever the storyline may be.
Yeah, I think if I come across these situations, to be honest, I've got a separate portfolio which I know at the end of the day I'll either transfer it over to that portfolio or I will just buy it in that one there, knowing that that's my emotion, that's my sort of attachment portfolio with companies I think that are good companies, right? So, but then if you're trying to run a trend trading portfolio, then you've got to really try and stick to your rules. Otherwise, it's no real point having it, right? So it's like any other portfolio, right? So, but maybe having two separate portfolios could solve that issue where you want to keep companies that look good, right? Look good on the books. All right. So, what about what we'll finish off on this question because it's still related to an ATR. Like, out of interest, what do your ATR drops typically work out in percentage terms from the recent high to stop loss? I understand they're all vary per individual stock, own unique volatility as they started. So I think it's more about the percentage of stocks that would hit their ATR stop roughly. Do you know what percentage would be?
I think there was the percentage decline to hit the trailing stop. Is that right?
Well, we could answer both. So what's your what's your average percentage decline? Yeah.
Really rough. I'd say the 10 ATR stop roughly works out at around 25%, but it's going to vary. If it's a stock that is like Dexus Convenience, it's not that volatile. Its trailing stop is going to be closer. If it's a stock like Mineral Resources, the 10 ATR stop on that was going to work out to be more than 25%. But I think generally around, really rough, around 25% for my 10 ATR, adjusted 10 ATR, because I also do some other stuff with it. So it's not just a straight 10 ATR. But it's not saying everyone should use a 10 ATR stop. Got to work out what is it you're trying to achieve? What do you want to do? Do you want to trade short-term movements over the next 2 weeks? Okay, fine. You probably don't need a 10 ATR stop. Do you want to stay in a stock for 1 to 3 years? Okay, you're going to need a different type of stop. You're going to need something which is going to be able to see off multi-month consolidation, see off deeper corrections. Now you do need to look somewhere like a 10 ATR. You want to hold stocks for 5 to 10 years. Well, you need another strategy altogether. So it's got to be fit for purpose. Whatever you do, it's got to be fit for purpose. Some people come in and they freak out at this 10 ATR stop and say, I could not sleep at night. That's just so risky. That's okay. It's not everyone should be trading individual stocks over a medium-term time horizon. Some people are better off just with their ETFs and don't worry about it. It doesn't have to be for everyone, but if you want to do those medium-term trends, I don't think really there's any way around using those wider stops. You can call up any stock that goes up 100, 200%, and they're going to almost certainly have several pullbacks of, say, 15 to 25%. If your stop's too close, you can't see them off, so you can't stay on the trend. It's just the way it is. I'd like to have close stops and trade medium-term trends, but it doesn't work, unfortunately. So, but I like the medium-term trends because I like those staying with stocks, not having to be active every day doing stuff because I'm doing short-term trading. I like the active investing approach. We can buy stuff, hang on to good stuff for 2-3 years, exit stuff which is not working relatively quickly, and for me that works. But I've got to have that wide stop.
Okay, fantastic. I think they've answered that quite comprehensively, and yes, I think that's the idea, right? The shorter the term you want to trade, the shorter the trailing stop. Just and just be wary. There's that other setting there, right? So you never change that, do you? That 14, which is measuring the true range over the last 14-day period, right? You don't ever change that one, do you?
On TradingView, no. It's like whether it be 14 days or 20 days, it's probably not going to make a great deal of difference.
Yeah.
But that's all part of backtesting. It's one of the variables. So it's one of the things you test out. Like, do I want to measure the stock's volatility over the last 2 weeks or the last 2 months? And you do the testing and see how it works out.
Yeah. All right. No worries. Well, I think we might wrap it up from there, Jason. This has been a good show. We've done a lot of analysis of tickers there for everyone, which is great. I hear that the Blues and the Maroons are coming down to Melbourne tomorrow to play to battle it out. I'm assuming you're going to go for the Blues. Is that right? So
Yeah, I'll be backing the Blues. We're one down, so got to come good down to Melbourne.
well, hopefully there'll be a few people there coming to watch it down here in Melbourne. So it's at on the big stage in the MCG, and I might have to go for the Maroons, Jason, just to be a little bit different, mate. And we'll touch base again next week, and we'll see who's won that. All right.
Sounds good.
All right. If you want to go check out Jason, obviously he's at motiontrader.com.au. Feel free to go and check out his trials. And yeah, it's end of financial year now, right? So, I don't know. You always check with your accountants. You never know what could you might be able to write it off on tax if you're doing this as an investment or as a living, right? So check out his services. And if you want to check out our services, it's selfwealth.com.au as well. And you could have the same thing where we've got a premium membership sale there as well, and you get your 10 free trades. Go check that out if you're not a member already, obviously, or a client already. With anything we've talked about today, please remember, do your own due diligence and do your own research because you never know with stocks, right, or the markets. So thanks, everyone. Thanks, Jason. Much appreciated. And we will chat again next week.
Yeah, pleasure as always. Thanks for joining us, everyone. Rog, it's been fun.
Thanks, guys. Take it easy. Bye-bye.